Okay, good. Now, correlation. Okay, what is correlation? Or what do you understand by correlation? So, as I had said earlier, that correlation coefficient, of course, it's a measure, it's a statistical measure, okay? And in this case, it measures the strength of the relationship between relative movements of two variables, or it measures the strength of the relationship between what? Between two variables, okay? And we've said that it ranges between, that is, the values ranges between -0, okay, and 0. A calculated number greater than 1.0 or less than -1.0, then it means you add an error while calculating or while measuring, that is your correlation. Okay, so correlation cannot be any value greater than 1.0. Like for example, it can be 1.1. Okay, it can't go, that is, like, in short, it can't be what? It can't be greater than what? Than 1. It cannot be greater than 1. Okay? Yes. Then, and also, we've said that it can be less than what? Negative 1.0. Like you can get a correlation of negative 0.0, even 1. Okay, it should be between negative 1.0 to what? To 1. Okay, all right. So in case you get another value greater than this or less than this, then know your calculation as what? As some errors. Okay, okay, good. Now, um, a correlation of -1 shows we have a perfect negative correlation, while correlation of 1 shows a perfect positive correlation. If we get a correlation of 0, then it shows we don't have any linear relationship between those two variables. Okay? We don't have any linear relationship between those two variables. Okay? Like for example, let me just do a number line. Okay? I know you can remember number line back in high school. So we have 0, we have that is 1. All right, here we have 0.5. Okay, here we have -0.5. All right, and here we have what? We have -1. So we've said that this is known as any value which is 1. It's known as perfect positive correlation. Like whenever we get a correlation of that is of 1, okay, then it means we have a perfect positive correlation. Okay, whenever we can also say that any value between 0.5 to 1, we can say that we have a fairly positive correlation. Okay, as we move toward that is 1, we can now say like any value between what? 0.85, let's say 85%. Okay, we can say we are this is what? This is strong. We can say this is strong positive correlation. Okay, so anything between 0 and -5, then we can say we have what? A very poor positive correlation. Yes, we have correlation, but we don't have that strength when it comes to what? When it comes to when it comes to the relationship between these two variables. Just an example, okay? I want us to measure what are the determinants of salary when it comes to jobs. Okay, what determines salary? I just want to come up with a linear relationship, okay, which we can use to get more understanding between what, in terms of strength of the relationship, okay. Like for example, let's try a model. We have a model which is we are using to determine what, which we are using to determine salary, okay. Definitely we'll have a constant. Let's say this is constant 1 multiplied by x. X is our variable, it's our first variable, and this is our second variable, okay. Then plus another constant, let's say constant theta, okay. So in this case we can say x, let x be what, the experience in years, because we know experience do determine salary, okay. Experience do determine the salary, maybe you are, which you are going to be what, you are going to be paid, okay. So in this case I'm using experience as our variable, okay. And of course we know we have a very strong relationship between salary and experience, because of course I can't exchange my experience, which maybe I have had for 5 years, with just a token of like of appreciation. No, of course the salary must match, that is my experience, okay. So in this case that's why I'm saying experience in this case will be what, will be a very key factor, or it will be that is my major factor to determine salary, okay. So now, from layman's language, you know that as that is I experience, okay, I experience definitely will do what, definitely will mean I salary, okay. It will definitely mean I salary, okay. So in case you try to find or calculate, given maybe you are now given data for salary, okay, and then data for that is age in terms of experience, okay. That is, you have x1, you have x2, you have x3, you have y1, y2, okay. Y is salary, x is the what, is the experience. So in this case definitely you will find that we have like it's like we have a coefficient, that is a correlation coefficient more than what, almost 0.85, okay. Why? Meaning we have a very strong relationship, okay, very strong relationship between what, between that is between salary and the years of experience, okay. Maybe when we'll be calculating our that is our exam, that is our practicals, we'll come up with something we call that is covariance matrix, sorry, correlation matrix, okay. We'll come up with something called correlation matrix, okay. Yes, so in that case we'll be trying to see, maybe you are given that is like for example we have two variables, okay. We have salary, we have experience. We will have a value, we'll check, that is the covariance between salary and salary, okay. Salary and experience, experience and salary, and experience and experience. So where we have that is we are trying to find the relationship of each other, then we'll get a 1, meaning definitely experience will 100% explain about itself. It will 100% that is explain about experience. When it comes to salary, salary, it will 100% that is describe salary and salary, okay. So in this case our outcome matrix, let's assume maybe we have a correlation between maybe the correlation between salary and experience, it is what, 0.8. So in this case you will find salary and salary will be 1, okay, meaning they are perfectly positive because they are explaining each other. Okay, it's like maybe explaining myself about myself. Okay, so definitely that will be like we'll have 100% like strength. Okay, then salary and that is experience, then it will be what we have assumed to be 0.85. Okay, experience and salary will remain as 8.5, and experience will be what, will be 1. Okay, yes, so basically that's what we'll do. I was just explaining more about what, about covariance, and I gave maybe an example of maybe salary and what, years of experience. If you are, those are two different variables. If you were to calculate that is if you were to calculate the strength, okay, in terms of relationship, then you will what, you will get that is a certain relationship. Okay, all right. What let's say now, if I'm trying to maybe compare salary and height, salary and height, salary and height. So definitely the relationship between salary and that is your height and salary which you are being paid, definitely you'll get a covariance of 0. Like we don't have any relationship. Okay, we don't have any relationship. So for that case, we can say we will have a correlation of almost 0, meaning we don't have any linear relationship. Okay, we don't have any linear relationship. What do we mean by the term linear relationship? Like for example, if we were to now plot experience and salary, okay, we would get like a linear equation, or we'll get a linear that is a line, a straight line. Like for example, let's say this is experience in years. Of course, this is our x values, and then we have salary, okay, as our what, y value. So let's say in the first year, if you have 1 year, maybe you are getting paid maybe 20,000. Okay, let's say we have that plot. If maybe you are having 2 years, you'll get maybe double of that. Let's say 40k. This is 40k. If you have 3 years of experience, maybe you'll get what, 60, and the trend continues. So like here I will have to do here, and here I will have to. So if I plot this, sorry, I can't make a perfect that is a straight line, but if I were to plot this line through this, okay, we could get what, we could get a straight line. Okay, meaning like we have a linear relationship, linear from straight. Okay, like a straight line would get that is a relationship which is linear. Okay, and in this case would be what, we could have a positive correlation. What about negative correlation? For negative correlation, it would mean when when y is increasing, okay, sorry, let me, when y it is decreasing, x will be what, x will be increasing. Like for example, if I start from this point, we're having y it's at high, if and x it's at low. When I decrease y, you can see the x value as what? Has increased. Okay, so in that case, the what? For negative linear regression, or sorry, for negative correlation, we'll have, if we are to plot it, we'll have something like this. Okay, we'll have something like this, but we'll learn more about this when we'll be discussing about linear regression. Okay, about positive linear regression and negative regression, it's all of the same thing. Okay, all right, that is in pictorial or in presentation manner. Okay, all right, now let's try and see how can we use, or how can we apply, that is, correlation. I guess correlation, okay, I did not talk about the negative side. So the negative side also applies. Like here we have perfect negative correlation. Okay, here we have like a strong negative correlation. Here we have a negative, that is a weak, or a poor, negative correlation. Okay, so basically this, number, that is number line, summarizes everything. Okay, we shall now maybe get more details, when it comes to, the practicals, but just to give you a heads up, 0.85, it is mostly the considered, that is a correlation. Okay, when it comes to positive correlation. Why? Because it shows that 85% of your, that is of your variables, okay, have relationship. Okay, they have almost the same relationship. Okay, yes, so that's what, uh, basically, means. Okay, now correlation statistics can be used in finance and investing. For example, a correlation coefficient could be calculated to determine the level of correlation between the price of crude oil and the price, of, that is an oil producing company, that is the stock price. Definitely here we will have a correlation. Like for example, let's assume of Total. Okay, we have stock price or share prices for Total. Okay, so definitely what do you expect when the fuel price, okay, or the petrol price goes up? What do you expect? If the price of petrol hikes, okay, so, that is, and we are taking an example of Total company. Okay, so definitely the total, that is the Total company stock prices will do what? Will also hike. Okay, when the prices, reduces, most probably the share price might what? Might dip. Okay, so the best, those, for those who do trading, like you usually talk about dip. Okay, the price has dipped, so invest more. Okay, like buy more stock or buy more shares. Okay, so that now when the prices, that is go high, you can now share your price, that is your shares, and enjoy what? And enjoy profits. Okay, yes. So, but you have also to take some risks, do some market, analysis for you now maybe to, that is, to make that decision, because it might dip and never come back to the price at which maybe you bought it. Okay, like for example, if you bought the share at 10 shillings, okay, per share, then it dips and states maybe it dips up to 3 shillings for almost 1 year. Okay, so definitely you can see you will be suffering 7 shillings, a loss of 7 shillings per share. Okay, so those are some risks which you have to take, and also you have to do what you have to do some market analysis before you can make those decisions. All right, so since oil companies earn greater profits as oil prices rise, the correlation between the two variables is highly positive. Yes, that was a very perfect that is relationship. Like definitely, if the price of the crude oil will increase, so definitely the shares of that company will do what? Will also increase. Good. So just okay, let me take this slide there. Also take this one here, this one here. Okay, now let's continue. Understanding that is correlation. So there are several types of correlation coefficients, and the most common used is the Pearson correlation, that is R. Okay, remember I had also said that when it comes now to regression, you'll find ourselves that is calling that is correlation coefficient as multiple R. Okay. Yes. So this measures the strength and the direction of the relationship between two variables. It cannot capture nonlinear relationship. So you can see, cannot capture nonlinear relationship. So that's it. So for when you talk about that is correlation, then there must be what? There must be a linear relationship between what? Between these two variables. So it cannot capture nonlinear relationship between two variables and cannot differentiate between dependent and independent variable, because either one can be what? Can be that is can be what? Dependent or independent. Like for example, for the salary model, we can also now change to predict now what? To predict the years of experience given maybe a set number of what? Salary. Okay, then a value. Yes, someone? Frederick, you have a question? Okay, maybe you unmuted by mistake. So, a value. Okay, so a value of exact, this is what already I've discussed. So we are just going through the notes and see if we have any difference. Okay, so a value of exactly one means there is perfect positive relationship between the two variables. For a positive increase in one variable, there will be also a positive increase in the same variable. Okay, and also a value of negative 1 means there is a perfect negative relationship between the two variables. This shows that the variables move in opposite direction. For a positive increase that is, for a positive increase in one variable, there is a decrease in the second variable. That is for that is correlation. Okay, or for the negative correlation. Okay, so if a correlation between two variables is 0, then we can say we don't have any linear relationship between what? Between those two variables. Okay, so we are saying that the strength of the relationship varies in degree based on the value of the correlation coefficient. For example, a value with 0.2 shows that there is a positive correlation between two variables, but it is a weak and likely unimportant. Analysts in some field of study do not consider correlation correlations important until the value surpasses what? At least 80% or 0.8. However, a correlation coefficient with an absolute value of 0.9, that is 90%, or a greater value represents a very strong relationship. Okay? Represents a very strong relationship. Okay? It's like when we are talking about confidence level. Don't confuse confidence level and correlation. Okay, so when it comes to research, we have social research, okay, and also we have medical research. So when it comes to that is a social research or the normal research, we usually use a confidence level of what? Level of that is 85. Like for example, your statistics must be 85, must have a confidence of 85%. Okay. When it comes to medical experiments, okay, or research, it should be 99%. Okay. It should be 99 perfect. That is 99%. Anything lower than this, then you might have to relook on your data. Okay, you might have to look your data. All right, then let's go to some takeaways when it comes to correlation coefficient. So for correlation coefficient, we've said it is used to measure the strength of the relationship between two variables. We've said Pearson correlation is the most commonly used in statistics, and this measures the strength and the direction of what? Of the linear relationship. Okay, then values always range between what? -1 to +1. Okay, yes, and then correlation coefficient value less than +1 or greater than -0.8, sorry, less than +0.8 and greater than -0.8, they are considered significant. They are not considered significant, sorry. They are not considered significant. All right. So correlation statistics and investing. How do we use correlation? Okay, to make maybe that is a what, like a decision. Okay, like maybe mostly I'll talk about maybe financial markets. Sorry if I'm too into finance. Okay, but you can always give me your field of maybe field of work, and we can come up maybe with also your own examples, okay, or applications. All right, so the correlation between two variables is particularly helpful when investing in financial markets. For example, a correlation can be helpful in determining how well a mutual fund performs relative to a benchmark index. Remember, I talked about this benchmark index. Like when we talk about index, that is index 500. Okay, meaning we have a set price under this is combination of like more than 500 that is companies which maybe come up with what, with a specific share price. Okay, so you can benchmark, okay, that is a certain share or a certain that is asset performance with this. Okay, so with that you will see that is maybe by adding a low or negatively correlated mutual fund to an existing portfolio, the investor gains the diversification benefit. Like it's like you are not putting your eggs in the same bucket, you are combining poorly performing and also good performing what assets. okay, investments. So with this, at least you will have diversified. In case maybe this low performing, that is a mutual fund, okay, at the point where maybe the price increases, okay, definitely you will enjoy profit. And in case that is the high performing loses their what, their that is loses its value, or it performs poorly, then you can do what, then you can as well be secured with what, with the other that is with the other mutual fund. Okay, so like you are diversifying your risks. Okay, if you are a risk averse person, you can always what, you can always opt to diverse. Okay, but again, we usually say the higher the risk, the higher the gain. Okay, the higher the risk, the higher the gain. All right, good. So correlation statistics also allows investors to determine when correlation between two variables changes. For example, when a bank stocks typically have a high positive correlation to its interest, take this take note of this. For example, when bank stocks, we know the bank stocks are that is have a high positive correlation to its interests. Okay, since loans rates are often calculated based on the market interests, then if the stock price of a certain bank is falling while the company is still increasing what, increasing its interest rates, okay, then you will know that there is a problem with that bank. Okay, maybe the bank, it's running bankrupt, so it is trying to do what, it's trying to resource more money, okay, for it to recover. All right. So, like for example, if the stock price of a certain bank is falling while interest rates are rising, investors can glean that some things or something is askew with that particular bank. And if the stock price of the other banks in the sector are also increasing, investors can conclude that the decline of the outlier bank's stock is due to maybe the interest rate. Instead, the poorly performing bank is likely to be dealing with an internal fundamental issue. Okay, so definitely, if now the stock price is increasing and the is increasing, then you can say that a bank is performing. But if maybe the stock price is decreasing and the interest rate is increasing, then there must be something wrong with that bank. Okay, something it's as that is at skew. All right, yes. Then we have the formula for that is for correlation. So correlation, we calculate it from covariance. Okay, remember I said that is the formula for covariance. Let's say covariance of x and y. Okay, we said that is given by summation of xi's minus y, that is x bar, sorry, minus x bar, okay, multiply by yi's minus what, y bar, okay, and then you divide by what, by n. Okay, so this is covariance. What about now the correlation? So for correlation, okay, we've seen that is given by covariance, that is of the two variables, let's assume x and y, okay, divide by the standard deviation of the what, the product of the standard deviation, like standard deviation of x multiply by standard deviation of what, of y. And in this case, you will have mathematically computed what, you will have mathematically computed what we call correlation. Okay, all right. I guess this it. So this is the Pearson product moment correlation coefficient. All right, and that's of course we had discussed this. This is the formula for covariance. Yes, and then that's marks that is the end of my first topic. Okay. Yes, that was a 40 minutes class, which was also